I would like to turn things over to Meg Bodie, the president and founder of Talking Hedge Events. Meg, it's all yours.
Thank you, Ken. Terrific. Hello, everybody. Haven't seen you I can't see you, but you haven't seen us for a while. I think we concluded our summer series of webinars in mid-August. I hope everyone enjoyed the rest of your summers and kicking off your fall in a good way. Almost Halloween. Really a fun weekend for so many. Welcome to our new series of webinars. This is our fall series, and it's replacing our trip to Santa Monica, which, again, I say this every time, we're really sorry we can't be there. Really been California dreaming. It would be great. And we were just talking about it earlier. It's getting chilly in New York and chilly up in Montreal and Toronto. The guys on the panel were saying, it's getting cold. Anyway, this series has an overarching theme of customization and alignment for the benefit of institutional investors, sort of the next chapter, new generation. And we're kicking off today with exactly that, a new generation of alpha customization. We have a terrific panel. They're going to talk about investment alpha as well as operational alpha, some things that are trending right now, some new things going on, and really a little bit futuristic, looking at what's coming down the pike, which I think you'll find really interesting. I found it somewhat surprising, but all of you out there probably will say, yep, knew it was coming. I want to thank our sponsors. Everybody in the industry has just been terrific all through this pandemic, and Talking Hedge has really enjoyed engaging with so many of you. I want to thank InnoCap, Investment Management. I want to thank InfraHedge, which is a division of State Street. I want to thank Bodie Research Group. I want to thank Graham Capital Management, Martlet Asset Management, O'Brien Investment Group, and Vidrio Financial. You'll be seeing representatives from all of those firms as we roll out this series on customization and alignment. There's so much to talk about, different themes, and we hope you really enjoy it. So I also just want to mention we have fabulous partnerships with 3 associations, AMA, CASA, and Kaya. They help us get the word out about our various conferences and webinars, and we thank them. Those are wonderful relationships that we have. So let's get into it. Let's bring in Graham and Wei and Jonathan and Daniel. You can pop on your cameras. And I am going to now introduce Graham Jones, who is really a moderator extraordinaire. He's really good at this. I think these guys are going to have some fun, and we look forward to your comments and the answers to the poll questions. So I'm going to leave. Have a great session, and I'll be back on at the end. Thanks.
Thanks, Meg, and welcome one and all to this morning's panel on the new generation of alpha customization. I am your host, Graham Jones. I'm a managing director and head of sales at Scotiabank Prime Services in Toronto. I want to warmly welcome Daniel, Jonathan, and Wei to the investment management metaverse. I think that's what we're calling it now. And so before we get into it, can each of you give us a super brief intro of yourself? You can spare us your son of a sharecropper story, but let us know a bit about your role in the asset management food chain. So Daniel, why don't we start with you?
Sure, thanks, Graham. So my name's Daniel McDonald. I worked as a portfolio manager at Ontario Teachers Pension Plan from 2000 to 2016, focusing on liquid hedge fund strategy allocations. I was instrumental there in getting a large part of the portfolio implemented and invested via managed accounts, and transitioning away from fund to funds, like in the early 2000s, to direct investing post GFC. Now, in 2017, I left to join Middlemark Partners to head up their advisory and consulting effort, and really working on a lot of different pension plan client portfolios, everything from managed account implementation, fee negotiations, risk mitigation, research. So the sky's the limit. I'll turn it back over to Graham.
Thanks, Daniel. Jonathan, give us your intro, please. And who's the
Yes,
raccoon
sir.
in the background?
The raccoon is my guide, actually. We'll have a discussion about it later on. Welcome, everyone. Thank you for joining us today. My name is Jonathan Planté. I oversee the business development and strategic marketing team at InnoCap. InnoCap is the $25 billion managed account platform owned by Caisse des Dépôts et Placements du Québec and BNP Paribas. From a personal standpoint, I spent, almost 16 years in the alternative investment industry across both private and public markets. And for the past 9 years, I've been working at InnoCap, mainly facing investment teams at large pensions, both in North America and Europe. I spent a lot of time helping them to structure and operate the external allocation through dedicated managed accounts and through any asset classes. This is how I met these interesting people today on the call, and I'm very happy to be here with you guys.
Good stuff. Thanks, Jonathan. Wei, how about you give us a quick intro?
Sure. Good morning, everyone. My name is Wei. I co-lead a public markets portfolio called the Multi-Strategy Investment Program at a Canadian pension fund called OP Trust. We manage in total about $24 billion of assets. The portfolio that I oversee is approximately $6 billion, focused on liquid strategies across all strategy verticals. So in the time that I've been kind of leading that effort, come across subject matter experts such as Daniel and Jonathan here. So I'll try and add my perspectives along the way, and this will be a very interesting panel. So looking forward to getting to the specifics here.
Awesome. Thank you, Wei. So today we're going to spend some time on how asset owners are evolving their managed account investments to squeeze more alpha from their external manager relationships. And then hopefully we're going to pivot to a discussion on how technologies like blockchain, digital currencies, and even decentralized finance are creating a new arena for adventurous asset owners and asset managers. But first, Ken in Mission Control, can you throw up the polling questions to get our audience involved? So hopefully everybody sees them up on their screen. If you could just take a few seconds to move through those questions, and this is just to help us understand, know thy client, know your client, know thy audience, which is the first rule of a proper seminar, I suppose. So work on that, and then in the meantime, I think we'll begin our conversation with you, Jonathan Planté. Given your role at InnoCap as a bespoke tailor of customized solutions for asset owners, how does your firm work with an allocator to implement a program through managed accounts? And also, how are managed accounts evolving into new variants? I know that's a fairly loaded word these days, and I apologize. Jonathan, how about you start us off?
Yeah, I'm going to try to do it in less than 3 hours. And thank you for the pronunciation of my last name. It was pretty on point. So at InnoCap, our angle is really to create dedicated managed accounts, which means that basically we create efficient fund structures in which the client, being asset owners, so the client asset managers deploy the client's capital in the client control and transparent environment. Meaning that what we do is we create an entire ecosystem for large asset owners. The way we do that has basically three main parts. The biggest one is the design of the blueprint of dedicated managed accounts. And it has all the verticals of the teams that we have internally. First and foremost, I will say from an investment and risk framework standpoint, we define the investment objective and the constraint of the program with the client. And we propose a risk framework at the fund level, but also at the program level for the portfolio management team at pensions. We are not a consultant, so we are not here to say you should invest in this manager or you should have another strategy enroll in your program. We are basically here to translate the investment vision into a real and concrete framework. And we do that, as I mentioned in my intro, across all asset classes. We were born out of the balance sheet of National Bank of Canada back 26 years ago, so we have a huge DNA in hedge funds, but nowadays we do a lot of infrastructure projects, real assets type of strategy, and obviously hedge funds. So we create really the risk framework across any asset classes. Then we're going to discuss how to articulate from a trading standpoint the strategy. So we are connected to more than 96 trading counterparties, meaning that we're not trying to impose a trading counterparty to a manager. We are just trying to recreate what's best for the fund and for the client. So risk framework, trading environment, and obviously due diligence process. We work with the client and their advisors. Sometimes, especially in the US, large pensions are advised by consultants. So we really start up a project where we're trying to add to the table from a DD perspective. So that's from an investment and risk perspective. Now, we also do legal and compliance, meaning that we're going to design the legal structure, be it a limited partnership, an SPC, a trust, a UCIT, an AIF. We have basically funds in Cayman, in the US, in Canada, in Ireland, in Luxembourg. So we are very versed to any kind of fund structure. On top of the fund, we also negotiate the trading documentation. We have more than 7 open contracts with those 90 trading counterparties. We do also corporate affairs, meaning that we articulate the board of directors, and we manage the relationship with the regulators, meaning that as a registered company with the SEC, the CFTC, the NFA, the CBI, the Luxembourg regulators, we are here to manage the interaction between the regulators and the fund. So investment risk, legal compliance, and now operations, because most of what we do is really trying to liberate this alpha, to free this alpha from the strategy. So in the operation team, we work in tremendous time to select the right service provider for a fund. We have now more than 9 administrators already connected to the platform, and we have the capacity through our systems to connect to any administrators. I'm sure we're going to talk about it from an IT perspective later on. We have more than 5 custodians, 4 auditors, and 3 tax consultants. So really it's investment, the first piece. How can we frame that? How we can articulate that from a legal and operational perspective? And then obviously, how can we share this information with the clients? And this is the last piece, really the data management analytics. So how to create an ingestion and digestion process of this information, and how to be of a support, not only to the investment team at the pension, but also at the back and middle office, meaning that we're going to feed their risk matrix or whatever system they use from the middle office perspective, or we're going to feed the accounting system of the back office. So that's the entire design of the blueprint of the DMA. Then before going to the creation of the DMA, we're going to obviously price this blueprint, meaning that before starting the project, the client will know every single cost that will be attached to the creation or to the management of the structure. And this is really important for us, because one of the pillars of our business is with transparency, not only on investment, but in this case, on costs. So create the blueprint, price it, then onboard it or create it, I will say, create the DMA. Obviously, we have a large team for the onboarding, and we spent a tremendous amount of time trying to reduce the ETA for deployment. The fastest that we have done, and I'm sure that we're going to talk about it, was about 20 days during the pandemic. So from the ODD, IDD to the capital deployment. And we are very active in co-investment or high conviction idea structuring, where we now target launch in less than 2 weeks. Last but not least, we manage the day-to-day of the DMA after obviously creating it. We act as the registered entity So we oversee all the responsibilities in the fund, from manager due diligence to ongoing updates of trading docs and operational matters such as reconciliation, financial statement review, and so on and so forth. So all that to say that in order to create that, we work with the client. And once again, it's not only investment people at asset owners, it's really the middle and back office as well. And we are kind of the glue that attach all the components, all the teams internally at asset owners.
Great, Jonathan. Thank you for being the glue. Wei, I really want to lob a similar question your way. As an allocator to liquid strategies with a $6 billion portfolio, how are you evolving your managed account investing?
Sure. Maybe just taking a step back and thinking through like how allocators generally approach investing into liquid strategies. I think Daniel made a point initially. Usually, where people start is through some type of fund-to-fund program, right? So allocating directly to a commingled fund, and then trying to diversify across different types of fund strategies. I think that approach, it's what causes kind of the flaw in that approach is that the end result of the net return that you can capture as an allocator is actually, there's a very high opportunity cost in terms of a lot of things that you're kind of giving it away through that type of friction in terms of designing a portfolio that way. You have friction from the perspective of the fact that commingled funds are not built to spec for your needs, right? It's built to a generalized pool of capital, many different investors in those pools. You have friction from the perspective that you are allocating physical capital, and it is not really doing so in a way where it could be as capital efficient as possible if you were able to effectively extend that capital into liquidity directly on your own balance sheet. There are obviously operational frictions, right? I think Jonathan's making the point that there's kind of the investment side where the investment team does the due diligence from an investment perspective, but there's really this entire kind of universe of operational due diligence, compliance, legal, et cetera, where if you want a very sophisticated and robust program, your entire institution has to scale effectively, not just your investment division. And I would say in liquid strategies, especially more esoteric hedge fund type strategies, the operational side is actually where a lot of the risks reside. So particularly for a mid-sized pension fund such as ourselves, we were, you're always confronted with decisions around, buy versus build. And you have to be very, very careful in terms of, being honest with the capabilities that you have. So there are times where it's better to buy the solution where you're able to contract with service providers that gives you that level of operational infrastructure that you just probably wouldn't be able to replicate internally. So at OP Trust, we employ a hybrid approach. We're not prescriptive in terms of saying everything has to be through a dedicated managed account or everything has to be through a commingled fund. I think it's a competitive market out there, and sometimes you have to trade off different things. Some strategies you just cannot obtain in a managed account format, and that's okay. If they bring enough value in other ways, then we would be able to do that. However, I think on the balance, where possible, we would prefer to implement things via managed account structures for all of the reasons that I mentioned, because in effect, what you're doing is you're recapturing that leakage in that entire, call it value creation chain, right? And it's the leakage that really kills these portfolios. And really that's, I think from my perspective, that's how I think about managed accounts as an implementation alternative. Is like you can harvest the alpha on the front end. That's the gross alpha. But if the entire pipeline is not efficient, your gross to net, there's a massive spread. And really going down the path of dedicated managed accounts or managed account structures is you're recapturing some of that friction such that you're kind of preserving as much of that gross alpha as possible. So Yeah, that's kind of largely how we think about it. And the implementation, again, it's judgment based, but we definitely work through partnerships that where it's useful for us to implement through managed account structures. So I'll leave it at that for now.
Great, thank you. So next, I want to ask some TikTok style questions that the kids call kind of hot or not about the popular investment styles of 2021. Jonathan or Daniel, what are you seeing that's hot? And on the flip side, what mandates are on the wane from an allocator's perspective, and more importantly, why? Jump ball. Jonathan?
Maybe I'll jump in, Jonathan. So what I'm seeing is a lot of allocation to private credit. And I guess it's kind of late cycle reaching for yield. And on the flip side of that, I'm seeing investors very concerned about rising rates, equity markets at all-time highs. So they're looking at risk reducing strategies as well, risk mitigation, crisis risk offset. Jonathan, do you have anything to add? What you're seeing as hot strategies?
Yeah, sure. For me, it's not about the strategy, actually. We are seeing a flight from investment strategy towards investment ideas. So we still have clients going for, emerging managers, and they chase the entire strategy of the asset manager, but they are looking more for specialists. They are looking for, very specific commodity trading, for instance, and sometimes there are private deals in commodities, so physical transportation spread, these kind of things. And then we see also a lot of, as you mentioned, trying, diversify away from the equity market and the bond markets. So few fixed income arb strategies, a lot of global macro, but once again, with specific themes. And I think from an investment perspective, when our clients are looking at strategies nowadays, it's really a completion to the rest of their portfolio. It's very directional in nature. So that was, I will say, the first third of the year. For the second third of the year, and even if you look at the pipeline right now that we have for the next 6 months, we see way more involvement from pension into investment ideas. People sometimes call it co-investments. I prefer to refer it as to be best ideas in reality. So we've done, more type of activist kind of transaction through what is called appraisal rights. So pension put like $115 million into one security and took it private. We are seeing more appetite towards intellectual property rights as well. So a lot of esoteric kind of ideas, but I think the theme that is common is really getting more involved into deals. Not only buying entire strategy, not necessarily customizing a strategy that exists, but really working on the idea or the deal flow of a manager and trying to source something different. And obviously, those deals are more time-sensitive deployment than any investment into a fund of one or coming goal. And that's why we are seeing a lot of appetite to do it through a managed account platform.
That's really, really intriguing, actually, going from the general to the very specific alpha generation concept. Thank you for that, Jonathan. Great insights. Ken, maybe now is a good time just to show the results of the poll. So the first question we asked was, how would you identify yourself? There we go. A quarter of you, more or less, are investors. Some solutions providers, a lot of fund managers. That's, I guess, the largest cohort. And then on down the line there. So what strategies are important to you? It seems like we're across the gamut of return seeking, risk reducing. That's intriguing. Number 3, do you currently offer or use customized investment management solutions like co-investment or managed accounts? You get a single choice. So a lot of you are very active in DMAs or SMAs. A lot of you are not, a quarter. Question 4, we sort of decided to be somewhat futuristic, so we asked some blockchain questions because hopefully we'll be able to pivot there on the back half of the conversation now, or I guess midway through. When do you think blockchain technologies will be broadly adopted as operational infrastructure in investment management, not just retail crypto trading, of course? You have a single choice there. So most people are saying it's 2 to 5 years out, but also a decent cohort are either unsure or saying it's like the next cycle. I think I'm going to be somewhere in the middle of that graph as well. Is your firm evaluating cryptocurrency as an asset class or opportunity set? That's interesting. 1 out of every 4 are already long the asset class. Some of you are feeling the fear of missing out. Some are waiting for a wipeout, and a lot of people are on the radar. It's interesting that within our prime services business in Toronto, we do have a decent amount of, the brand name hedge fund managers, mostly in the U.S., tipping their toe into crypto financing, mostly on the backs of our margin financing of the new crypto ETFs that have been launched, both in Canada with some of the first ones, and more recently with ProShares and others in the United States. What we are seeing in terms of crypto financing in particular is that all of these managers are effectively market making these products. All of their trades are very short term. So thank you for that. Thank you for all your responses, and we'll move on to the next question. And so I think that no discussion in front of investors and managers can skip over that old chestnut about fees and alignment of interests. So Daniel, can you update us on the proverbial race to the bottom? And what do you think are the best forms of GP-LP alignment when it comes to fee structures?
Well, back in my days as a PM, the ultimate alignment was incentive fee only. And so we would try to get the management fee as low as possible. On the other hand, we tended to invest with smaller and emerging managers, and they need that management fee to keep the lights on and build their operational infrastructure of their firm. So oftentimes we tied the management fee to firm-wide AUM. It was a tiered management fee that decreased because management fees are and costs and expenses are not linear to AUM growth. There's economies of scale, obviously. So it just made sense to do it that way. The other thing I'm seeing with fees that I think Jonathan mentioned co-investments earlier. That's an effective way. If you have a strategic partnership and relationship with the manager and can negotiate fee-free or low-fee co-investments, that's also an effective win-win way to lower overall fees for investors.
Good stuff. So one follow-up question on the topic, Jonathan. Outside of fees, are there other ways that GPs and LPs can become more closely aligned, or is it always there's a tension always there?
Yeah, just to bounce back on the answer of Daniel regarding the fees, I would like to share my very highly scientific approach, which is the $5 sushi rule. If you pay your sushi is $5 out of the gas station, don't be surprised to get sick on the next day. And I think that what I'm trying to say by that is that, any work should be compensated. In the end, be it an hedge fund, a private equity firm, it is a business. It has to be run. It is run by people, and people need to make money out of it. So there are different ways, I guess, of monetizing your relationship. When Daniel mentioned emerging managers, it could be the pension or the asset owner being a reference for these emerging managers during, RFPs or when they are trying to raise capital to act a bit more actively as a support from a marketing standpoint. But in general, and I know it's a very philosophic way of thinking, I will say that you just have to be very forefront when you are an asset manager, when you engage with a pension, and be very clear of who you are as a firm, but also as a group of individuals. And the way you present really yourself will be very clear on what you can bring to the table. And it's not only, negotiating an allocation because you need capital. So for me, it's more tackling the relationship from a human perspective rather than a business perspective. And then there are, multiple ways that you can find to monetize the relationship on both ends, being, sharing network, sharing intelligence on specific activities. And I think that, especially in Canada, it has been a really great pleasure to work with large pensions because this is really the philosophy that they approach, that they take when they approach relationship with external managers.
And just a quick follow-up to the $5 sushi. I think a lot of investors have smartened up, and they have a lot of new technology. There's software analytics firms, P&L attribution software platforms out there that investors can use to decompose manager returns and portfolios to see, is this alpha I'm getting or just a packaging of 4 ETF factors that I can get for 20 basis points. So I really think investors have come a long way in knowing what they're paying for.
Yeah, it's a good point. I mean, Dana, you do have a unique perch as really one of the true pioneers in managed accounts, stretching back to your days at OTPP when I used to cover you here in Toronto. And so while you began your career in Canada, you're now focusing, I think, as I understand, more on US plans. So I guess the question for you is, where are you seeing, real innovation in the North American asset owner marketplace at the present?
Yeah, because I've worked now in both countries, Canada, the US, I'll do a bit of a comparison where I see US leading the field versus Canada and vice versa. And we'll start with managed accounts. So managed accounts are kind of old hat in Canada now. Almost all the large institutions and pension plans invest via MAPs and managed accounts. Whereas in the US, you're seeing a recent uptake. I think there were some pioneers and thought leaders in the US, like CalSTRS, South Carolina, MassPrem, that have been doing it for a number of years and have been quite successful. And other public plans are looking at them and their success and trying to do the same thing. Back in the US, though, where I think their thought leaders are, you see a lot more risk mitigation portfolios and strategies, crisis risk offset, whereas Canada, I think it's just starting, which is surprising because Canada, I'm seeing a lot of total fund management and portfolio construction groups, kind of top of the house, where they're centralizing a lot of total plan, risk measurement, monitoring, research, and that's where you're seeing a lot of the research into crisis risk offset and risk mitigation. You're seeing a lot of centralization of FX hedging, liquidity management, and leverage also at the top of the house. Whereas I'm not seeing that type of organizational structure happening yet in the US. And the other surprising thing that I'm not seeing as much of in the US is portable alpha. So once again, it's old hat in Canada. A lot of investors have invested that way, using derivatives, swaps, or futures to get their cheap equity beta exposure, and then using the cash savings from that derivative exposure to invest in uncorrelated alpha strategies. But a lot of US plans have governance restrictions on investing using derivatives. And that's really holding them back, I think. And I think that's kind of the secret sauce to a lot of Canadian plans being able to lever, 1.2x to 1.4x. And those returns compound year after year after year. So I think, just in a nutshell, those are the 3 or 4 areas where I can compare what I've seen in both Canada and the US.
That's great. Thank you. So our topic speaks in somewhat breathless terms, I would say, about the many technological advancements in asset management plumbing. So Jonathan, and then back to you again, Daniel, can you let our audience know what shiny new apps you guys are using in your practice to help plans with total portfolio management? And how have these technologies been enabled by improvements in managed account platforms over the past several years?
Sure. So to bounce back on Daniel's topic about, portable alpha, any type of leverage, we implement a lot of this strategy through notional funding at InnoCap, meaning that at the fund level, we create leverage through the relationship with the banks. And obviously, the onboarding that we had in the past, I will say 2 years in terms of technology, is really having the transparency in the aggregation at one place of all the counterparties that we have. So today I can look through my system and see which counterparty is cheaper for financing across the globe for a specific asset that we have on the platform, or at large, which basically what the amount of dollars that we are paying for to any type of bank. So we are way more active in the management of the counterparty that we used to be. And we also provide cash management. So those solutions are quickly evolving. And because we are an independent firm, it's a bit easier for us to, plug and play to what we believe being the best technology on that front. So for this tool, for example, we use ESL3, the full suite for treasury solution, margining, cash collateral management, so on and so forth. So we became like we have the same information that all the banks have, but at the one spot in our system. So that's from a front office perspective. Then from a data ingestion perspective, obviously it's good to be able to talk about and know about all the counterparty fees and what's traded in the fund, but it's also important to know how can I aggregate the 250 million data points that I receive per day in my system. And once again, we've made a strategic partnership 2 years ago with a technological firm that is very large. Basically, what they do for us, they provide new algos that helps us to digest information way faster that we can do it physically. We are not an IT shop, although we have a lot of technology in the company, but our forte, our mission is not to develop IT tools. It's actually to partner and see what's the best in the industry right now and how we can improve our protocol in order to support people like Wei in their management of their portfolio. And I think that, once again, having the capacity to connect to these applications that can be rented or purchased on the market is really a key differentiator. And hopefully we'll see what's happening in the blockchain for these matters. But for now, in the centralized finance, I will say that technology is evolving fast, and we are not near the end of this process.
Yeah, and just to follow on to what Jonathan's saying, there is so much data out there, and having been on the other end of managed account investing and all the transparency, it's kind of useless if you can't translate all that data into meaningful information or metrics. So what I'm seeing from some of the best platforms and risk analytics and P&L attribution platforms out there is converting all that data into dashboards. So here's an equity-long short risk metric dashboard. Here are the 10 most important metrics for this manager, for or for this merger arbitrage manager. Yeah, because as a PM, you can't look at a gazillion line items or risk analytics. You're going to focus kind of on the top 10. And then the other important innovation that I'm seeing is being able to, like Jonathan said, that it's more than just strategies, it's often ideas. So risk mitigation is kind of a concept. Some strategies can be managed internally, like long duration treasuries, and some have to be done externally, like global macro or trend following or complex tail hedging strategies. You need an aggregate picture. So you need to be able to aggregate the internal traded strategies and the external, bring them together into one aggregate view, so you can stress test and run the analytics on and get the total picture. So that's a really important innovation. And portable alpha is another one where you've got internally traded equity, cheap equity beta exposure, and then the externally managed alpha strategies.
So Wei, when you're having your morning coffee, what does your dashboard look like when you're looking at your managed account platforms? Is it attribution you're looking at? What are those top 10 metrics that you're trying to filter out to avoid the stack noise, so to speak?
Yeah, and seeing a couple of questions coming through around data. I think both Jonathan and Daniel make great points. Like, there is more than an abundance of data out there. The impact is how you're able to distill that data and make it useful for decision making. From my perspective, I'm more looking at portfolio level aggregated data as opposed to manager level or strategy level data, and it is slightly different between those two levels in terms of like the pertinent views that you should have. So from a portfolio level, admittedly, it's a bit more slower moving. So I'm not as worried about the noise on a day-to-day as I am more focused on things like risk factor exposures and trying to understand what is truly driving the performance and the returns. The segmentation of how much of our returns are driven by explainable factors versus residuals. Trying to get a bit of kind of an intuition around what that residual could be. Because the residual itself has volatility. It goes through cyclicality sometimes as well. And then just making sure that we have a thoughtful balance across risk factors, across manager diversification, across the speed of different strategies that we're employing. So it's more from a portfolio construction perspective. That would be kind of my view on the dashboard and the things that I care about. And then the PMs would be obviously much more on top of the specific risks and the specific drivers of different types of strategies that they're covering.
Right. So continuing with you, Wei, in addition to your third-party manager remit, you've been focusing on investment opportunities in the crypto ecosystem since 2018, I think you said. Mm-hmm. And so while I'm no monetary futurist, perhaps you can help me. So do you see digital assets as an asset class or an investable opportunity set?
Sure. I think my answer would be crypto and blockchain technology is actually broader than that. It's actually intersecting like multi-layered kind of technology that's going to impact a lot of things. Financial services being one of them, and I think that is actually one of the limitations in terms of how people interpret crypto. Is usually the first introduction into crypto starts from the perspective of Bitcoin. And so people conflate that crypto and blockchain is in fact something that has to do with money, when in fact it isn't, in the sense that it's a meta technology that enables a lot of different things. Money was the first application that really utilized the technology, but it is not the technology, right? So I think the starting point of exploration of blockchain and crypto should not start from Bitcoin. That's my personal view. Now, I would say this is not a disparaging remark on Bitcoin as a asset. I think there's obviously some utility to Bitcoin, especially in the context of its comparison to gold. But notwithstanding that, I think the approach and the perspective that people should take is that it is a technology first, and then the applications of that technology is wide ranging. Financial services very much right in the direct line of sight of what this technology can change. Right, we talked about operational infrastructure. What blockchains are is it's a new layer of digital infrastructure that's on the scale of the internet, but is very simpatico with the internet. And what the internet enabled was a digital infrastructure for information transfer. Blockchain is a digital infrastructure for value transfer. And now you have both layers converging and working symbiotically. And what that enables is radically different types of financial services. Just like the internet radically reframed how we communicate, how we ingest, digest information. So I think that's the first layer. Is the blockchain itself is digital infrastructure. Crypto is actually not blockchain, and I think it is important to disaggregate the two things, because blockchain is the infrastructure layer. Crypto is like, on the internet you transmit information through packets, right? Crypto is that packet on the blockchain infrastructure layer. It's a container, but it's a software container. So within that container, you can program any arbitrary complexity of financial services logic, and in fact, over time, more complex logic than just financial services. And now you're able to move that on this infrastructure layer that's now frictionless, low latency to no latency, highly efficient, highly much more productive, and massively enhance the throughput velocity. So all of, like, the combination of the two things is going to basically change many things. And I think to kind of keep it brief, the exploration of crypto and blockchain from my perspective was that as a pension fund, we're an asset manager, we're an investment organization. You know, financial services, every single vertical within financial services will be impacted by crypto and blockchain. When you think about investing going forward, not only are the strategies going to change, because crypto as a programmable container means that there's new value, sources of value, different types of risk factors that you can now construct by design, right? Because it's composable and it's programmable. So that expands the investable opportunity set. The infrastructure layer is enhancing in terms of like pickup and efficiency, throughput, latency. And then you have this actual like social layer in terms of how decisions are actually made in a decentralized format. You know, every single aspect of, you know, the asset management supply chain is going to get touched by this technology. So I think for us is trying to be not even ahead of the curve. I think it's the pace of change is coming so fast that it's hard to stay ahead of anything because it's just changing so rapidly. But at least trying to keep up with what's changing, and then, you know, thoughtfully formulating a view that when there is a requirement for us to think about how to pivot our strategy and our business model, we have to do it, because if the internet was any indication of a potential experience for the blockchain and crypto, then you know, financial services are effectively like, you know, the Blockbusters and the Kodaks. Like, we don't want to be going down as a case study that the Harvard business students learn about in 10 years, which is really like what's confronting us, right? So our strategy is trying to get out there, learn about it, integrate it where it's thoughtful and methodical. It's not to go out there to take a big bet on Bitcoin. That's not what we're doing. It's actually the counter to that. And I think if you're starting from that perspective, you're probably thinking about the opportunity and the risks that, in a rather siloed and isolated way.
Super insightful. Thank you. Jonathan, Daniel, from like a practitioner's perspective, John, how might blockchain and distributed ledger technology affect your middle office, the back office at a prime broker, and the front office at the investment manager who's listening in today?
So from a personal standpoint, first, I want to fuel the discussion with Wei. People have to understand that the cryptographic network idea goes back to 1991. It was not born in 08. Bitcoin was born in 08, but not the idea of a blockchain. And to bounce back on Wei, on Wei words, I will say that for me personally, I believe that we are experiencing right now the largest socio-economical paradigm shift since the Second World War. It's not only one generation of kids living in the basement of their parents saying, I'm not having this life, I don't trust the financial system. It's a lot of people saying we need to change the way we live. We have different beliefs now. And it's mostly articulated around the mutualization of knowledge, mutualization of capital, of time. And in this mutualization, you don't even have to trust your counterparty, because the idea is that the blockchain, the technology itself, is your counterparty. So it's really a shift of a magnitude that I think like people are gonna, realize soon that it's way bigger than we thought. Now, if you look at the activity that we are seeing from a hedge fund perspective, the largest trade on the blockchain was made a year ago, right after the US elections, actually by a manager called One River. They traded $600 million of Bitcoin and Ethereum. And I will invite you, all of you who are trying to understand what blockchain is, what crypto are, is really to look at the newsletter of One River CEO, Eric Peters. He is very insightful and very resourceful. Now, from a practitioner standpoint, I wouldn't say that our clients are trying to trade Bitcoins, that they have a view on relative value trades, on short Bitcoin, ETF, along the spot. I will say that they are interested into the technology. And that's why you are seeing more and more large Canadian pensions financing companies operating on blockchains. So we had 2 transactions in Canada just during the past month. Both of them was close to $500 million. So they are lending money to company to operate on the blockchain. Now, to answer your real question about InnoCap, we are not obviously on the blockchain yet. We are first and foremost trying to educate ourselves on who's there from a service provider standpoint and how the technology in the blockchain can fasten the reconciliation process of all operational matters. But you have to understand that, people 4 years ago discovered the Ethereum blockchain like at a bigger scale, and Ethereum can, solve or reconcile information very fast. But if you take new protocols or new blockchains such as Solana, they can reconcile 50,000 transactions per second. So I'm not saying that today, October 29th, there is a clear application to the financial industry for that. But I will say that this kind of protocol that can operate at a fast pace, basically you can reconcile your entire book in 1 second, 1 or 2 seconds, for almost no fee, which is the fraction of a cent on the dollar. So I think that we are at the pace now that we are educating ourselves, we are looking at what's there, we are talking to a lot of people, especially academics, but also entrepreneurs who have been successful in this environment. And we will look very closely in the near future, maybe to articulate the first trades, futures or spot on the blockchain directly. But we are not yet this far. The closest that we've seen is some, global macros trading one or two futures on Bitcoin and Ethereum, but no request for the moment from a large pension saying, yeah, I want to buy, Atom or any kind of overcooked.
Okay, that's great. We're getting close to the end of the session, so thanks for your comments. Daniel, I really want to just ask one final question of you, and then we'll throw it back to Meg for a wrap up. And it's really my favorite type of question. It's the kind of question that Biden would ask the chairman, so to speak, when he visits China, and that is, what's the big issue that's keeping allocators up at night? That's I think what our audience would want to hear from you.
I think we're transitioning from in a central bank easing cycle into tightening, and when you have 40% of a typical pension plan allocation portfolio in fixed income, that's worrying because we haven't seen rising rates in 15, 20 years, and what are you going to do with that allocation? Where are you going to shift that bond exposure? And will that bond exposure serve as a negatively correlated asset to equities in flight to safety times of crisis? Probably not. And with rates as low as they are right now, it's a drag on total plan returns. So we're seeing some institutions like Ontario Teachers making bold moves, saying, inflation is around the corner. Let's take 5% of our fixed income exposure and put it into commodities. And I think that's paid off beautifully for them. And I think that's what's keeping a lot of institutional investors awake at night.
That's terrific. Thank you, Wei and Jonathan Plante and Daniel McDonald. Great conversations. Too bad we only have an hour, but thanks for your words and your wisdom. Meg, over to you.
Yeah, wow, rising rates and that speeding train called blockchain. And we all have a lot to wake up for and worry us in the middle of the night. It's crazy. That was, you guys told a story, sort of how the whole managed account trends, have evolved and where they're headed. And then this whole blockchain thing is obviously a little more futuristic, but that was so well done. That was really a story. And I thank you for that. And next week, we're going to, stick with the theme of customization, really looking at customized completion portfolios. So come back for that. And then we take a break for a week. And then in November 19th, I think it is, we're going to talk about ESG, which is so critically important. And again, alignment of interests is a key there. So Wei and Daniel and Jonathan and Graham, great job. Thank you all so very much. I hope everyone enjoyed it. We'll see you next week with our second webinar. Take care.